Hey guys, so I'm going to do this video about, this specific video is about swing trading with the market timer spreadsheet. So let's bring up the market timer spreadsheet here and let me show you the starting point of making the decision of when to do a swing trade. Now, first, the swing trade system that I'm going to show you is based on a number of different indicators in the spreadsheet itself. But there's a couple that are more important than others. Number one is that included in the spreadsheet, the market timer spreadsheet, is a swing signal algorithm. And that is either going to be pointing up or down based on a number of factors that are included in the spreadsheet. Most of the formulas are actually hidden, but some of them are based on other indicators in the spreadsheet. And so you're going to get a up signal, like this is an up signal, or you're going to get a neutral signal, which is this dot here, or you're going to get a down signal. Typically what happens is that when you see a neutral signal like this, it means that there's a change in trend coming. And so you get the up signal, and that ends, we get a neutral signal, and then we get a down signal. Now, that in itself can be traded quite successfully. As soon as you see the swing signal change from an up to a neutral to a down, at that point you want to take a potentially short position, or if it goes from a down to a neutral to an up, you want to take an up position. But what I found is that it makes it even more effective when you combine the swing signal algorithm with the pipeline, and I'm going to show you exactly how we do that. So here's the secret in using the spreadsheet with the swing signal algorithm and the pipeline. Number one is that you want to take a look at the lows and the peaks of the pipeline. And the way I measure the lows and the peaks is by taking the third column of the pipeline and the flow and looking at when it's rising and when it's declining. So in the pipeline, when you have a flow that is rising consistently from here, in this case it went from 91 to 105 to 113 to 114, the difference between the third column of the pipeline and the flow gets to the point where it's about 20%. So this is 132, this is 114. So it's pretty close to, so at 18%, once you see the pipeline and the flow difference is around 18%, that typically means that that is the end of the decline. And in this case, on March 2nd, 2018, the Dow was down 70 points, and the third column of the pipeline and the flow is approximately 18-point difference. But here's the key. That's the exit of the position. The swing algorithm is down, and this is separation by 18 points. So that is the time to exit the position. And then the opposite is true when you want to exit a long position. You take a look at the third column of the pipeline and the flow. In this case, we had a difference here of approximately 14 points. This time, when the market is going down, the third column of the pipeline is going to be higher than the flow by about 15 to 18 points. And when it's ready to go down again, the difference in the third column of the pipeline and the flow is going to be approximately 14 to 15 points as well, especially when it gets down into the 50s, like it did here. And so when it's down to 50 and you've got a flow at 68, that's a difference of about 14 points, and you had an up signal. So it's important that when you're entering a short position, that the number one is that the swing signal algorithm is down. So you've got a swing signal down, and then you have an increase in the pipeline with the third column turning red, and an increase in the flow. If you have an increase in the flow and the swing signal is down, then you take a short position. When the swing signal peaks by 14 or 18 points, you still have a swing signal down, you exit the position. All right, so let's use this as an example. Entry to a short position is when you start to see an increase in the pipeline and the flow is rising. So for example, in this case, we're looking at the third column of the pipeline going from 99 to 91 to 92 to 82 to 92. So at this point at 92, the flow has risen above 90. That's the time to take a short position. And we've got a down signal algorithm. So you can look at this, the flow and the third column of the pipeline, as the pipeline is an indicator, the swing signal algorithm as confirmation of that signal. So let's go ahead and you will use the Think Back program and Thinkorswim to see how well we would have done in this position. Okay, in this case we're using the Dow S&P spreadsheet, so let's go ahead and use the Dow. We use the diamonds as an example. We use options on the diamonds. Now we know that most of these are very short-term trades, so we don't have to pay extra premium for options that are far away. I would highly suggest, though, that you don't use the weeklies, that you use the regular expiration option chains. So in this case, we're looking at the pipeline rising and the flow rising. We see the pipeline in the third column starting to rise above that 90% level. So we're on the alert that we're probably going to get into a short position, but we don't enter the short position yet until we get the flow above 90%. And we have the swing algorithm down. So if the first day we get the swing algorithm down is the 23rd, but we don't have a flow above 90%. So we have to wait until we get 90% above, the flow is 90% or higher, and we have a swing signal algorithm to confirm that, and then we take a short position at the close on that day, so 227. So we're going to go back to 227. And then we're going to take a look at the diamond chain. And we see that we have the weeklies, and then we have March 18. That's the one we want to take. We want to take the closest expiration, typically as long as there's at least a couple weeks. A lot of times the swing signal will only last maybe 4 or 5 days or a week at the most, so we want to take the closest expiration on the regular option chain. And then what we want to do is we're taking a short signal. We want to go in the money on the put side, and we want to take at least an 80 delta. So we're going to be taking this one right here. So the 261 puts, and we're just going to buy 3 of those to be conservative on the position. And let's see what happens. So now what we're doing is we're looking at the flow rising. So let's go to the next day. All we have to do is advance the date here. So on the 28th, we're already up $1,000 just on the very next day. So at 3:45 p.m. Eastern Time on the day, you update the spreadsheet yourself so that you have the flow number. And if it's above 90% and you've got a swing signal algorithm that's down, you take a short position at 3:45 on the puts. The very next day, we are already up $1,000. Now, the test of finding out, remember the test here, is when we don't exit the position until the third column minus the flow is over 15%, around that area. So the very next day on the 28th, you can see that we're at 102 and 105, which is not a large separation at all, and so we're going to advance it to the next day. On 3-1, now we're up $2,200. On 3-1, we have the third column of the pipeline, and the flow is a difference of just 3%. So we're not quite at the point which we're ready to exit the position yet. We also have continued confirmation. So each day Not only are we looking for the difference between the third column of the pipeline and the flow, but we're also making sure that the swing signal algorithm is down. And so we're going to be doing our updates at 3:45 every single day, so it gives us time to update the spreadsheet and to exit our position if we have to. So, okay, so now we are on the 1st of March. And so on the 1st of March, we see we have a small separation in the flow in the pipeline, third column. We still have a confirmation of a down signal. So now we take it to the next day, which is 3-2. On 3-2, now we're up $2,475 at approximately 3:45. We update the spreadsheet. We see that the pipeline has gone from 132 to 114. We have about a 18 point difference in between the pipeline and the flow, the third column and the pipeline. We still have a confirmation of a down signal. However, the difference here of the pipeline and the flow is over 15, is around 14 or 15 or over. And so now we have to exit our position. And you can see that we have $2,475 profit in just a few days. Now what we can do at that point is we can take the opposite position. We can take a position for the market to go higher, or can we? Well, we still have a swing signal algorithm, so we don't have an up signal to confirm our choices. And so we can wait until the swing signal turns up. At that point, we're already below 90%. So the ideal situation, the ideal time to take a long position is when the flow, remember we took a short position when the flow rose above 90, we take a long position when the flow declines below 90. And we have confirmation of the up signal. So we didn't get a good signal here. We're already below 90 here, but we did not have confirmation of an up signal on the swing algorithm. And then we didn't get the swing signal algorithm up until here. And we're below 90, so we could take a position here on the 7th. So let's advance the calendar. We'll go ahead and exit this out. We made $2,475 on our short position, and now we can increase our date here to March 7th is the first confirmation that we have of an up signal. Flow is below 90. We take a long position at the end of close the trading on the 7th. We update our spreadsheet at 3:45 every single day. And we still have 9 days left in these March options. So we're going to go ahead and take a 80 delta or better in the money call position, long position. We're going to go ahead and buy those. We're going to take 3 of those. And we're going to go ahead and do the updates. So now we're on the 7th. We're going to go to the 8th. 7th is the first day we got the signal. We'll go to the 8th. We're up $225. We update our spreadsheet at 3:45. We see that there's a 16 point difference here between the pipeline and the flow, and we have a swing signal algorithm that is still up. Now, typically what we look for is a decline of the pipeline below 60. So we're at 60, so we don't have to exit this yet. But it is close though, and we have a 16 point separation here, so we want to be on high alert the very next day. But typically we want to look for the third column of the pipeline below 60. We hit exactly 60, so we don't have to exit yet. So we're going to go to the very next day, which would be the 9th, and now we're up $1,400. We take a look at the 9th, and now we're below 60% on the third column of the pipeline, and we have a separation of, we have a 68 on the flow, which is a very low level. Typically anything below 70 is going to be a low level on the flow, and anything below 60 in the third column pipeline is going to be a low level on third column of the pipeline. So now we have a 14 point difference between the third column and the flow. We still have an up signal. However, at that point, because the third column of the pipeline is below 60, it doesn't matter too much on the upside what this is, because this can range from anywhere from 130% all the way up to 250%. What the primary decision-making process that goes into exiting this position is the difference in these two. The primary decision-making process in exiting a long position is when the third column of the pipeline drops below 60 and the flow in the pipeline drops below 70. Then you want to exit a long position. So we've already had two positions. We took a short position, we made 2,400 approximately. The long position we made approximately 1,400, which equals approximately $4,000 in the space of about a week. Just one caveat to this, and that is that not every signal is going to work out. However, you're going to have more pluses than minuses, and in the long run, you're going to make money, but you have to take the signals as they come. The signal works out more often than it doesn't. You'll make money in the long run, but just be aware that not every signal works out. You need to be diligent, though, in updating the spreadsheet between 3:30 and 3:45 every single day, so you can, Eastern time that is, so that you can update the spreadsheet, take a look at the spread between the third column and the flow, and the swing signal algorithm at the end of the day. All right, guys, hopefully that is helpful for you for swing trading, the spreadsheet for Market Timer. And if you have any questions at all, please email me or attend the live trading sessions, and you can ask me any questions that you have. Okay, the most important thing about this trading system is you understand that when the flow is continually rising and hits 90%, and we have a down signal, you take a short position. And when you hit the peak, and you have the flow drops below the 90% level, and you have an up arrow on the swing signal algorithm confirming the uptrend, then you want to take a long position. All right, guys, hopefully that was helpful. I will see you guys very, very soon. Please ask any questions that you have, and I'll see you in the trading room.